Welcome in. This is the Thursday Not So Deep Dive, a 30 to 40-minute show where you can learn about the basics of a stock in audio or video form. We're going to talk about Latch today. It's a SPAC. Is a SPAC with real revenue, and it's one of the most fascinating SPACs I've seen, I think, and I don't want to make a declarative statement too early. It's probably the best business I've seen out of a SPAC. We'll get into the valuation. It's the valuation, as you might expect, is a bit high, but we'll get into that later. I'll let Ryan introduce the company, but before we do you want to talk our presenting sponsor for the week, Quarter? I guess we should also say that Ian's not joining us this week. He is busy at his work. He's burning the midnight oil at the old internship, but he'll be back soon and joining us. So yeah, Ryan, do you want to introduce the company and talk about Quarter?
Yeah, I'm looking at Quarter's app right now. I've actually been using it. It's earnings season, so this is the time to have it. I'm going to be using it today for Corsair Gaming. They've got it. And the other thing that I like is there's no delay. With transcripts, if you're like a transcript reader on conference calls, you have to wait usually. These things are out pretty early, so you can go ahead and listen.
1.25 speed too, so you don't get the slow operator. You can speed through that stuff. It's great.
Yeah, I mean, it's super convenient. It's 100% free. It's on Android. It's on iOS. Go download it. They have companies from all over. There's 12 different markets. You can request companies, and they prioritize those. So you can follow them on Twitter at Quarter_app. It's QUARTR. There's no reason not to get it. It's the best place for investor relations.
Yeah, and remember, there's no E in it. There's no E in it. So it's
correct.
QUARTR, no E.
That's right. But I'll get into Latch. So Latch says their mission is to revolutionize the way people experience spaces. Seems a little overdramatic.
No, they're revolutionizing the world.
But they essentially sell a combination of hardware and software that helps operate residential buildings. So their hardware suite consists of like door locks, lights, temperature control devices, cameras for guest access, and there might be some others, but it's really, those are kind of the big ones. Most people know them for the door lock. So Latch has it's kind of, if you've lived in a big apartment building, you probably have seen these before. And you download the mobile app, you open the door with your phone. Brett,
I use it. Yeah, I'll probably maybe describe some good and bad stuff in anecdotal evidence, but yeah, you can use your phone. You just kind of click on stuff and it's electronically communicates with it, and you can kind of hold your phone next to it, and it does that near, what is it called? I think it's NFC. It's almost like Bluetooth, where it's like if you put the mobile device close enough to the door, it automatically reads it and unlocks it or locks it for you.
Right. And then they also sell subscriptions to the Latch OS, which is comprised of a bunch of different modules, and customers who are building management teams typically can select which modules they need to fit their building needs. So these modules include smart access. This is basically allowing management teams to control who has access to what doors, essentially throughout the entire building, because there's, communal lounges, gyms, stuff like that. And so it's not just each unit, but then also being able to separate the units into two distinct residents. And then delivery and guest management. This basically is their intercom system, which sounds like it has video capabilities too. Intercom systems, I have a bad one. So this is something that's ripe for disruption.
Yeah, my apartment doesn't use it. So that's a module that they do not have. I guess, ARPU, there's the potential for my building. But I don't have any experience with that one, but sounds like something a lot of buildings would want to use.
Yeah, it sounds like you can let people in pretty easily just with the click of a button or with a few clicks in the mobile app. And then they have smart home and sensors. So this is basically just allowing residents and management to control the smart devices throughout the building from their app. So you can like raise the temperature, turn on the air conditioning, dim the lights, stuff like that. And then they also have connectivity. This is basically monitoring and providing cellular internet across buildings. And then lastly is resident experience. And this continues to expand, but it's basically what residents get with the Latch app or what they get to see and the capabilities that are included in that. That's opening doors, controlling devices, all that stuff. And then there's also, we're going to talk about it, and it's kind of your future growth opportunity.
But adding more stuff.
Yeah, they're adding more stuff to that progressively. And then in terms of the sales process, they usually connect with management teams and developers early in the building process of like these big residential buildings. And so 1 in 10 newly constructed multifamily apartments in the US are equipped with Latch, but they can also retrofit older buildings with their tech.
I think 98%, or I'm throwing out that number, but almost all of their contracts are with new buildings, at least right now. It's been tougher for them to move into retrofit, but there's plenty of demand for new buildings. So.
Yeah, and then retrofit, if I remember reading it correctly, it has expanded, or they've grown the number of buildings that they've retrofitted they're growing across the board, but they've grown that as well. So it's not like it's slowing. It's something they can, just think about it. It's obviously easier to install it for the first time than to pull out an old system and implement a new one.
Retrofit's going to be, sounds pretty pricey.
And then since installation timelines can vary, hardware bookings result in revenue being recognized over 6 to 18 months, whereas software is often contracted out longer than 6 years, but oftentimes gets paid up front. So a lot of management teams are willing to pay this for 6 straight years or longer right up front because they see enough value in it. And basically their customer value proposition is that they increase revenue for the buildings because people have better security, better management of their units.
You can charge higher rentals.
Right. And they're decreasing the expenses for the management side. You don't have to do rekeying if people can't get into the building or whatever. It's all decentralized, so you don't have to be there at the building to help them out, and it just saves a lot of time and effort from the management side. And then I guess there isn't too much history about the business, but Luke Schoenfelder, I might be saying that wrong, is the CEO. He co-founded Latch in 2014 with 3 other people. Luke and one of his co-founders were ex-Apple employees, and they brought on
huge. That's it. It's guaranteed to succeed now.
And they brought on several other ex-Apple employees along the way. They've had a few funding rounds, including from their now SPAC sponsor, Tishman Speyer, who is also a real estate developer. So it's interesting that they have sort of an in there, because having the right partners in the real estate development process enables them to have generate more bookings, obviously. And then they've also expanded their software modules along the way. Hardware suites expanded as well. And it looks like Latch officially went public on June 3rd, so about 2 months ago. And they had apparently first considered the SPAC route back in 2019, and they got a bunch of different offers throughout 2020, but decided Tishman Speyer was the right one to go with. That's pretty much all for the history. You want to hit the landscape competition?
Yeah, this is I call it a pesky industry to look at because, doorknobs and key fobs and stuff, they're not like, it's not a market that are people really well known. Most of the time it's just a small expense for a building, but they're trying to make it part of the value proposition of owning a building. And then apartment manager software is not really a well-known market either. So I'm going to go off of their SPAC presentation, total addressable market numbers. Again, you should not take this as what they are going to get. This is just to show an example of the large market opportunity that, residential real estate and then other areas that they're pushing into could bring them. So they estimate, and again, this is internal, so they're going to be optimistic, that U.S. rental owners and operators represent $54 billion in TAM, And then if you add on Europe and then commercial buildings, which they are both going after for their current growth opportunities, I think they announced commercial recently, and then Europe, they're going into that soon. They don't have an exact date on it, but they're doing that in a partnership with Tishman Speyer. It's either Speyer or Spear.
Speyer.
Is it Speyer?
Yeah, I heard him say it on the internet.
Speyer. Okay, it's Speyer. And you can, the TAM going into Europe and commercial buildings will add much more than that, probably 200 billion, something like that. You're not really worried about market saturation here. They are nowhere close to that. Once Ryan will go through the earnings numbers. And they base this off of about a $7 to $12 in subscription fees per month per apartment suite. So the building is paying, a small amount for each room, but it's still not nothing. So they have to show that they're providing value in order for a manager to be willing to pay, $10 a month per room. Although from an owner's perspective, that's not too high. Competitors there are a ton. And there's a lot out there. So OpenPath and Ubiquity Networks have stuff for offices, and there's tons of others for offices as well. We have a small one at the office we're in right now called Brevo or something.
Brevo.
Brevo. Excuse me. Not a good product.
Nope.
I'll say Latch. If I'm comparing Latch to the one we have here, Latch is considerably better. There's August Home, there's Unikey, there's Lockatron, which is there's some weird names, and then there's a tons others. Most actually aren't directly competing for the larger apartment buildings, at least right now. And like August Home and Unikey seem like the best competitors when looking at online reviews and their website and their offerings. But that's just from a quick glance. But both of these companies are both more focused on individuals. So they're kind of competing, but kind of not. And there are a lot of competitors out there. I'm sure I missed some. I forget the one you have at your building, Ryan. It's called
Schlog.
Yeah.
Or something like that. But I think that's pretty much just, I need a key fob for that. It's not just from the phone.
So but they are competing with them, but it's not the same type of product because Latch has a more comprehensive offering. That's really the value proposition is not for the renters, but for the building managers. All right. You want to hit management and ownership.
Yeah. So Luke Schoenfelder, once again, apologize if I'm messing up that name, is the CEO. He's 31 years old. Like I said, ex-Apple employee, and he graduated from Georgetown. Thomas Meyerhofer is the chief design officer. He was also a co-founder. And then Garth Mitchell is the CFO. He's held several finance roles in the private realm. He's not a co-founder, but I think they brought him on. And then they also the base salaries in 2020 were about $280,000 for all the executive team members, but he got a $100,000 bonus. So I believe they must have brought him on and used, I guess, bonuses to incentivize him. And then the average age of executive officers is in the young 30s. Thought that was kind of interesting. And then there's 2 executive officers that own more than 1% of the shares outstanding. So Luke, the CEO, and Brian Jones, who is another co-founder, are the 2. And assuming redemption of all public shares, Luke will own 4.2% and Brian would own 1.7%. It's a SPAC transaction. I don't know if we've mentioned that yet.
I mean, balance sheet, I had to add some stuff up, but they could have burned a lot of cash. I mean, the balance sheet numbers I'm rolling with are estimates. They have not done a 10Q yet, so they were selective in their earnings release.
So it's also a little hard to gauge total ownership, but there are a few large investors that include Lux Ventures. So that's Josh Wolf's VC fund.
It's more than just him.
Yeah, but I believe there's a representative. I don't know if he's on the board of directors, but he's in with the company from Lux. Co-general partner, whatever's going on there.
You have to put one person from, or usually they put one either on the board or as a representative.
Yeah, and so they own roughly 12%, and then Avenir Latch investors would own 13.4% in that scenario. And that's just, Avenir is just basically, if I'm not mistaken, another VC firm. They try to go for growth companies, private and public, I guess. And then each executive team member, as I said, made about $280,000 in 2020, but they're moving forward. Those base salaries are going to be much higher. I think it's about double. I think they instilled a new compensation program in 2021. And then the bonuses are paid through a combination of cash and stock awards. Most of the current unexercised options outstanding belong to the CEO, Luke.
That's a bit, I don't like that because if you already have such high ownership, I mean, it's not like a deal breaker, but
I think they were granted in 2016, 2018. I'm not sure. It was kind of hard to judge.
It's kind of like the Activision Blizzard one where if you already have such a large ownership stake, why are you, getting so many options each year if you already have the incentive to do well because you have the large ownership stake? It's fine, but it's just something I don't really like. And maybe, it probably won't affect any sort of way I invest or anything like that, but I just don't like it.
It also, it makes sense for the other executive officers who I believe they brought on to kind of incentivize them that way. And then I guess that's really all I had for management and ownership. Just gut reaction to the CEO. It feels like I like him. I know he says a lot of, I guess, visiony stuff like we're revolutionizing spaces, but he does seem focused. The way they report financials seems conservative enough in a way, and what it feels very long-term oriented. We'll talk about why that is in a little bit. But I also think having Tishman Speyer as the SPAC sponsor, and I believe still an investor, even post
they'll own some of the shares post. I don't know what percentage.
I think it's very advantageous to have them. I believe they have a lot of international real estate
It's almost unfair.
assets.
It's almost unfair to have that advantage. I mean,
A little bit.
there's no way their new buildings are not going to get Latch products. So it'll honestly like a great way to even test out stuff because you won't, Tishman Spears, okay, or what is it? Spire will not. They're not going to like lose them as a customer if they test something out and then like something goes wrong. You know what I mean? It's almost like a prototype with them. Something like that. But that's a little bit getting into the weeds. I'll hit valuation. Market cap as of recording is about 1.91 billion. Ticker is LTCH. So the SPAC has been finished, I guess, is how you describe it. So
they always
you don't have
different terms for those.
Yeah. So the merger's done. It's technically like an IPO, and you don't have to buy into that cash thing that, the SPAC, how the SPAC goes and stuff like that. Enterprise value is about 1.41 billion, but they're expected to burn 150 million to 200 million in cash over the next few years. So I'm not exactly sure what you would want to use market cap or enterprise value when valuing this company, because I don't know, conservatively, they may end up burning a lot more cash. So is that really cash available to shareholders? I'm not sure.
I'd say booked annual recurring revenue is probably the best.
Well, I mean, I'm just saying
in terms of
market cap. Well,
sorry.
yeah, but I understand that. But market cap or enterprise value, I'm not sure exactly if that enterprise value is taking into account cash that will be available to shareholders or cash that is going to be invested. So should you use enterprise value? I'm not so sure, but I'm going to use it right now. Forward EV to sales is 28.8, but forward EV to bookings, which Ryan will get into why there's such a big bookings versus sales dynamic. Forward EV to bookings is 4.58. No other valuation metrics are particularly relevant right now because they're highly unprofitable. But Ryan, when he talks about earnings, we'll get into the margins and stuff like that. But I would note that since they are a SPAC, they've been able to guide out for 5 years and make some, they don't have to be super conservative on their projections. They are guiding for a huge free cash flow inflection in 2023 to 2025 and to hit about 250 million in free cash flow by 2025. So that's something that's kind of like a North Star that investors should look and see if you're owning this company, track and see what progress they're making on there. And I guess, one thing else is to watch the hardware, so software revenues and booking mix, because hardware revenue can make margins look worse. But if you're booking a lot of software, that's a lot of high margin revenue coming down the line. Ryan, do you want to talk about earnings and maybe more of those dynamics?
Yeah. And so as I kind of mentioned earlier, they're booking these contracts out for a really long time, especially the software ones. It's revenues recognized over 6 years and sometimes longer. But you're taking in, or Latch is taking in that cash sometimes completely upfront. And so in the most recent their recent quarterly report, they had $6.6 million in revenue, which was growing triple digits year over year. But total bookings for the first quarter was $72 million, and that grew 89% year over year. And so they've now, the numbers you really want to pay attention to is cumulative booked homes, because that's telling you how many new customers they're getting.
It's a proxy for ARR.
Right. And then they give booked ARR, which is booked annual recurring revenue. And right now that's at about $39 million, up 120% year over year. And so, yes, there will be times it's kind of a give and take, because the hardware is booked, or the hardware is recognized, the revenue from hardware is recognized over the first 18 months, sometimes up to 24 months. And so anytime that they sign a new customer on Latch OS, they're probably installing a lot of hardware as well. And so you're going to see, and especially if they use this SPAC cash to accelerate growth, you're going to see a lot of hardware revenue, probably, or hardware bookings recognized. And so it kind of takes a toll on margins. Long term, you want it to all be sort of software.
Yeah, that's what they're guiding for, or at least they're guiding for that mix to continue to go into the software direction over time. But that's why I mentioned earlier that investors are probably clamoring for some cash flow statements, or at least some audited. I mean, they don't even have to be audited, but just some GAAP cash flow statements to see how the deferred revenue dynamics work, because I know their bookings definition is probably similar to most bookings definitions, but I wonder how much cash they're actually taking in. And how, because you can book a lot of revenue, but when are they receiving the cash? That's a question for me. They do claim some stuff, but in the SPAC presentations, I'm not saying they're doing this, there's been ways, a lot of people have tricked investors into thinking something might be better than it truly is, which is why I really want to see that cash flow statement going forward.
I guess this isn't super detailed, but the CEO did comment that the majority of customers choose to pay that 6 years or that total bookings number up front. I believe he said that on a Motley Fool interview. And then I guess total cumulative booked homes is roughly at 369,000, which is 109% more than the year prior. So they are going really fast. And then it is, like I said, the financials are tricky, but between cost of revenue and operating expenses over the last year, they spent $80 million. So, but it's worth remembering that they recognize costs early and revenue late. So it really looks misleading. And then
they're guiding for 250 million plus in bookings this year. So look at that versus the cost.
And if you take cost of revenue as a percentage of bookings, which is probably not the right way to go about it, the company has 86% gross margins. If you take cost of revenue as a percentage, or you take gross profit as a percentage of revenue, it's going to look negative.
I feel like you got to meet in the middle of it, kind of look at both numbers.
Because they have a lot of installation costs, and I believe that's probably what makes up the majority of their cost of revenue. And then historically, they've spent very little on stock-based compensation, but this most recent quarter, they had a $13.8 million non-recurring cost associated with stock-based compensation, and then also warrant expenses. That was all due to the SPAC transaction. And then, like I said, the most important number to pay attention to is total booked homes and churn. And
they claim churn is zero. So lifetime value is infinite. So this company,
they've said,
is worth, infinite dollars, right?
They've said they've never churned a customer. And so I guess if people are like, why are you booking out for 6 to 10 years? Just think about the nature.
It's a minor expense in the whole building process.
Yeah. And think about the nature of the business. You don't want to have to change your entire lock system.
You're not going to.
You don't want to retrofit. I mean, you're seeing it with their struggles of retrofitting. Even with the legacy systems, it's hard. And so you want something that's really long-term. And I think they're kind of playing into that.
If it works, they're not going to churn. And that does bring, they claim zero churn. And that's good. It's obviously good that you want zero churn. But that if they're talking about lifetime value and stuff like that, lifetime value of the apartment buildings isn't infinite. But whatever.
All right. Balance sheet and liquidity.
Yeah. So again, I would wait for post-merger stuff because you don't know how much they're burning. At least I couldn't find anything updated when they updated their, Q1 or Q2 earnings. So pre-merger Latch had 46.5 million in cash, 56 million in convertible notes, which I assume are going to get converted, and then $6 million in term loans. And then post-merger, they will add $450 million in cash to the balance sheet. So that's where I get that approximate $500 million to subtract out to get the enterprise value. And then again, in the latest Q1 results, they did not give an update on the balance sheet, but like most SPACs, I assume there's no concerns liquidity wise. They will have a ton of cash. And to be honest, they might have more cash than they know what to do with because of the economics of this business. Nothing else much to say there.
Yeah.
All right, let's hit the ad break. Okay, welcome back. Anecdotal evidence. Unfortunately, in the second half, we're not going to have Ian today, so it'll just be us two. It might go a bit quicker, but that's fine. Ryan, do you have any anecdotal evidence here?
Well, no, not with Latch in particular. I live in a large residential apartment, the kind of business,
200, yeah,
the kind of building they'd sell to.
200 rooms or something.
And I think we could definitely benefit from the Latch system.
You're not one in the 10. You weren't one in the 10.
We are not, which is interesting because it is a newly built apartment building. So not sure, but what about you? Do you like it or not?
It's in my apartment. So I guess I have product experience. It's not really, the value proposition is less for the tenants because I don't know, it's fine. I have 100% success rate and it never breaks.
Do you have any pitfalls with the product? Anything you don't like?
The only thing I don't like is that you have to have your phone everywhere, which it's fine. If you forget it, you're kind of screwed. You have a backup key, but you're not really using it, so you're not losing it that much compared to a normal place. I like that the parking garage is secured by this thing, so it's no one's breaking into the parking garage or something like that. Yeah, I mean, it's fine. I believe the packages are delivery, like Amazon, UPS or whatever is all connected to this. I didn't really do much. And I mean, I know it's one of the modules, but I think my building has it where I just get text messages, package arrived. I think that's part of Latch, but I'm not sure. That could be something separate. One other thing is that, I guess you can see why managers would like it so much.
Do you feel like it's invasive at all?
I mean, it's fine. I don't know. I don't like how they can basically track everything from, so like if you leave your room, they can tell if you walk in and stuff. So the privacy impacts seem a bit concerning, but
yeah,
I don't think that's going to matter for it as an investment. As a consumer, I guess I don't really like it that much. I wish they had more stuff through it. I wish I paid my rent through it. I wish I could do a little bit more stuff in the app.
It might not. We also talked about this earlier. It might not be that much of a value add in our sort of area because it's generally pretty safe. But in less safe areas, this sort of security that people feel like they get probably adds a lot of money to rent.
Yeah, I think so. I think that makes sense. Besides that, yeah, I mean, it's simple. I mean, the secure access stuff is key, and then adding on new modules seems pretty easy to do. Yeah, but if they're not going into the new buildings like yours, I think they've lost your building probably forever. You know what I mean? They're not, I mean, that's a lot of money to refit a building of your size with that stuff.
Yeah.
So, all right, future growth opportunities. What do you got, Ryan?
Mine's Europe. I know we said no international expansion, but you pretty much took a lot of the ones that I wanted to talk about.
Hey, yeah, there's plenty. Yeah,
there are, and
commercial.
Yeah, that one I probably could have added that one as well. But they mentioned on the conference call that thanks to the cash they get from the transaction, they'll be better able to fuel expansion into Europe. And they plan to start with a focused approach and leverage their relationship with Tishman Speyer, who I believe has a lot of real estate assets and does a lot of business internationally. And so they said the first stage of expansion, they're going to be going after essentially Germany, France, and the UK. It feels like a logical step. I guess get everywhere you can. And especially when you have that relationship with a real estate developer of that size. Beyond that, commercial is viable. I'm glad they didn't go after commercial first just because of what happened with COVID. And there probably wasn't that many new commercial buildings going up. I could be wrong on that. But I guess as more and more people come back to the office, assuming that happens, it's a viable.
And a lot of commercial buildings already have stuff like this, I think.
Yeah, this could be a potential vertical moving forward, but I guess I would prefer residential. And then the other one, and I know you're going to talk about this briefly, but just channeling down all these different service providers into one offering is a huge advantage, not only for the management teams the building management, but also the residents. Because just as a resident, I don't like having to go to a bunch of different places to control stuff. And I guess you're going to talk about.
I'll talk about. So mine is the onboarding process for new tenants. They already do a fairly good job here, at least from my personal experience, where you download the app and everything's kind of set up for you. But they talk about how there's a big opportunity for, say, payment, onboarding, other stuff, security deposits, which is pretty antiquated. You still have to send in those either cashier's checks or whatever. You got to take it and hand it in at the bank. That's the only time you ever have to go to a bank anymore. In the SPAC presentation, they mentioned they're getting into other services as well. This could mean, utilities, Wi-Fi, insurance. I think those are probably the big three, or at least internet, not just Wi-Fi, but those are probably the big three that every renter is going to have. I don't think there's anyone right now that's not getting those three. Maybe not insurance, I guess, but doing those through the mobile application not only will improve the value proposition for the tenants because you can just do it all through there. It will improve things for the managers because they won't get as many complaints from tenants trying to get all these things up and running and stuff like that. And then I would think that insurance companies and internet providers would pay Latch good money to get them to be the promoted service within the app. So I think that's a great opportunity for them going forward. We'll see how much that can mean and whether it can help them raise their subscription prices, and we'll see how many people add on to that type of stuff. But they said it's coming. It's not out yet. So
I would have loved during my onboarding process to be able to go find my utilities, Wi-Fi, providers and renters insurance all from one dashboard, also paying rent, signing the lease, all of that, security deposit, all from one place. That's a huge advantage. And so if they're going into that, that's something, those different verticals or not verticals, those different add-ons to the operating system would be huge for, I think, residents.
Yeah. All right. Highlights and lowlights. What do you like, Ryan? What do you not like about this business?
I think it's an exceptional business. I think Chamath may have been right when calling it the stickiest software business he's ever seen.
It's not sticky because of software, though. It's sticky because no one's ripping out the doors. That's why. He's a bit misleading there, but whatever. He's right. He's correct.
Yeah, but maybe it's also because they provide a lot of, when we talk about booking out 10 years on the Latch OS, I think a lot of that is because people see no reason to churn because it's a good enough solution. But you're right. I don't think people are also doing that because they're probably not hoping to have to churn. And then I guess churn could increase potentially if spaces are torn down or replaced or something like that. So time will tell. I don't know if they'll cling to that no customers ever churn figure forever. But I also think and this will get into maybe more or less interested, but they have a bit of misleading financials to the conservative side. And I think that allows for a bit of price dislocation because sometimes that happens with bookings in general.
Yeah.
We see it with a lot of video game businesses.
Yeah. Roblox, people give egregious, they're like, oh, it's trading at 40 times sales. Like, no, it's actually not. Like if you looked at, it's not, because of the bookings dynamic is so misleading. But I'm curious because I wonder why are they not, cash flow positive if they're getting all this up front? I know that they're still going to get the software, but the only thing that concerns me is if you're getting all 6 years, boom, right away, and then you're recognizing the revenue, but it's not actually money coming in. Is there too much of a good thing there where you're just blowing all your wad? It's great, but if you're not free cash flow positive, this is why I want to investigate a few quarters of financial statements, like the true cash flow stuff.
And then they've also had cumulative homes booked has increased 583% over the last 2 years. So they are investing aggressively and it seems like it's working. Also, I guess I do like the business. Lowlights for me, it feels like they're either undercharging or the contracts are way too long. And maybe they are, to your point, citing that churn figure as sort of a giant highlight when it's more just the nature of the business.
Yeah. If any of these businesses have zero churn except for bankruptcies or like buildings go out of business, right? Who is replacing it? That's a lot of work.
Buildings torn down, maybe.
That's what I'm saying. I don't think that's included in churn because that's like, some of the buildings have had to go out of business. But
yeah. All right. What about you?
Highlights. It's all great. Margins, cash conversion, I think is good. Although again, I'll repeat myself. Want to look at that over a few quarters here. The low churn is great. There's a strong understanding of what they offer compared to what the competitors offer. I found when I went to Latch's website and through either the app or just kind of investigating what competitors look for, when you go onto Latch, you know what you're getting. It's an all-in-one offering. It works. It's secure access, but then add-ons. And then for managers, you can manage things very simple. It increases your efficiency. They really lay that out. But all the other competitors, you're like, why do I have this? Is this like a security system? Blah, blah, blah. And I think the product inserts itself as a win-win-win scenario where owners are saving money, even though they're paying more for Latch. Renters feel better because it's safer and easier to move around the building. Everything's just connected to your mobile phone. And then Latch wins because, they're getting money for this stuff. And lastly, I think the relationship with the SPAC sponsor may almost give them an unfair advantage. So the firm, when I looked it up just briefly, has about estimated 213 million square feet around the globe. I don't know how many rooms that is, but that seems like I don't know if they're all going to get retrofitted with Latch stuff, but they're in a relationship where they want to, they're probably going to do as much as they can there. Lowlights, the only thing is, How much is too much on early cash conversion? It could be too much of a good thing. I don't know.
Yeah, I agree.
And then typical SPAC stuff is the concern. We don't need to highlight that. If you have studied SPACs,
just complexities in the transaction too.
Yeah, I always feel like in a SPAC, I'm missing something, which is why I think that's why we have the rule that we don't touch anything until we have a few quarters at least, especially with SPAC. All right, bull case, bear case, wrap it up. Well, Ryan, what do you think has to go right here for Latch to be a good investment?
I think the bull case is pretty compelling. If their total booked homes continues to expand, it doesn't have to be at 500% every 2 years, but just they continue to go after more and more new homes that are built, and then they bolt on these new modules to the Latch OS. I think that's a huge part of it. If they can throttle down a bunch of those offerings or different services that are provided into a single place and not have it be so fragmented, I think that's huge. And I think
it's easy to see. I would love it.
It's also eventually they can start to charge more for Latch OS. Not only
they may have to wait 6 years though.
But when they do, there's no way people are churning.
That's true. I think pricing power is probably, you're right. Pricing power is probably pretty strong here.
And then if they are able to keep costs relatively consistent, at least operating costs and I guess cost of revenue kind of is susceptible to how much they're installing, but just keeping costs relatively consistent. And then, I could see a realistic world where they hit 500 million to $1 billion in booked ARR by 2020. I'm not going to make a projection that far out, but I could see a world where they hit that number.
Yeah, the variance seems high. We'll see what kind of trajectory they're going off in the next few years. But I think that's right. I'm kind of in the similar boat. You kind of got to expect, booked units, which is the key leading indicator to software revenue and probably cash flow over time. I think if you're an investor in this, you want to see that like 10x over the next 5 to 7 years, and then with really small churn and easy modules to upsell, which would be, more property management stuff, services, delivery. I mean, the most important thing is to just get into the buildings. Unless something is going wrong on the unit economics side, which I don't think it is, that's one of, if you boil this down to say 4 or 5 metrics, booked units is probably the most important one to look at first. Yeah, there's other financial stuff that's important too. And then at a low starting point of current revenue, especially and current bookings, and then, they're burning money right now. I think you will likely need to get to $1 billion in software ARR for this to make sense as a long-term investment, because we're not just thinking about realizing this, currently high or expensive multiple. You're thinking about, how do I get an acceptable rate of return from this expensive multiple? It could happen, but you're gonna need to see explosive growth. All right, bear case, Ryan. What do you think could go wrong here?
Well, it might be more competitive than I think, and I think the retrofitting dynamics I don't like them, because it's either, in my head, it would either be too costly to retrofit, and not worth the investment, or it's just not as common.
They're going to have to maybe get innovative on how they pitch people, like maybe give them a huge discount or something like that. It's clearly not going to be as easy as these new buildings.
It's just not as attractive and that isn't like, the market's large enough in new buildings that I don't think that's a huge problem, but I just don't think retrofitting is that big of a deal for them. Maybe real estate customers are just slow adopters, and they don't feel like, or they just don't care that much about, like, maybe what they're offering isn't as big of a deal as I think it is.
Maybe some good case studies of big, partners, Tishman, showing like a case study on a certain building that see how much money they save using Latch OS. I mean, that could be great. I'm not telling them how to run their business, but to get people to see how they're saving money. That makes sense. I guess mine, valuation is probably the big one that people are talking about. But without that, I have similar concerns or see any sort of risk kind of in the same light that you are. I think slower moving could be a thing because you are expecting rapid growth here. If any or all of retrofit, commercial, and international is harder than expected, growth it may not matter if all 3 of those don't work. But I think if those are slower than expected, there could be some headwinds here. again, I kind of come back to the U.S. residential real estate market that they're targeting seems quite large, but they're talking about those. Well, they talk about commercial and international big growth opportunities. Retrofit's just kind of a small thing they're doing, I think. But if those three things aren't as promising as they're saying, we could run into issues here. I have no idea if that will happen though. All right, more or less interested, wrap things up. What are your thoughts on Latch going forward, going on the watch list or not?
Yeah, I'm more interested 100%. I don't think the valuation is nearly as expensive as it comes off at first glance. Because
it's expensive, but not crazy.
Yeah, revenue is not truly representative of the kind of cash they're bringing in on a given year.
Yeah, and that comes back to the big concern. If you have 6 years of cash conversion up front, and I hope I'm using that term correct, but I think everyone knows what I mean. Why are they not cash flow positive? That's the big hang up for me.
Yeah, that's probably a fair concern. The big thing, there's always going to be like flaws, especially with SPACs. I don't think I've come across a perfect SPAC prospectus in a long time. But
I mean, there's no perfect business either, except, well, Google may be, but there's no perfect business.
Trying to get down to usually on an investment like this, it's one or two things that really end up mattering in the big grand scheme of things. And having minimal churn and tons of pricing power and having, I guess, a superior product because it's what it sounds like it is, I think that's going to drive returns. I would say this is about 20 times booked ARR multiple. That's high, but not as high as at first glance.
I think it makes sense. I'm more interested too. It's definitely going on the watch list. We talked about Matterport and we said that was probably the most promising SPAC from a business we've seen. I think Latch probably tops it from a business perspective. The concerns with the SPAC is I'm just going to have to wait a few quarters before making any real, I don't want to say like inroads on it, but doing any real research because I got to just check and see if there's any concerns and stuff like that, really see that cash flow. But I'm definitely more interested in this company. It's going on my watch list. I'll be tracking how they're doing each quarter.
Yeah.
Be listening to some conference calls on quarter. I think that's a good way to wrap things up. Or you have one more?
They did some conference call, or maybe it was a transcript and there were no questions. It was like a 3-minute read.
They just read off the press release.
I think it might have
been a SPAC thing.
Yeah. I don't know.
It's interesting. All right. Stock for next time. And we'll say that we should talk here that the not so deep dives will be moving to Tuesday. And we're going to do one a week. We're going to be alternating in the future with Brad 1 week. Next week will be Ian.
Yeah.
Next week after that will be Brad. Flip-flopping with them. Same exact format. But we're moving it to Tuesday.
It'll be Brad next week, Ian the week after.
Yeah, I'm just whatever. Flip-flopping.
Okay.
But what is the stock going to be for the next time we're with Ian?
Ocado Group.
What is that?
It's like a robotics automation kind of logistics thing for online retailers. I've shown it like a video.
Oh, you showed us a video. Yeah.
It's an $18 billion market cap. I believe it's headquartered in the UK. Pretty interesting business.
Sounds asset light.
No,
just joking. So, It'll be interesting. It'll be interesting. That should be a fun one. Robot automation stuff. Should be exciting. All right, that's going to do it for this episode. Thank you all for listening. Remember that we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan and I are general partners at Arch Capital. Arch Capital clients may hold securities discussed in this podcast. Thank you all for listening. We'll see you next time.